welcome to the deep dive. You sent over some really fascinating stuff this week, quite thought-provoking.
Yeah, there are some, well, unconventional ideas floating around.
Definitely. We're going to look at one potential strategy today, something being talked about in certain economic policy circles. It sounds pretty radical, honestly. Imagine the U.S. using tariffs, those import taxes, but not just for trade balance, using them as a kind of coercive tool.
Right, as leverage.
Exactly. Leverage to pressure countries, holding a lot of U.S. Treasury bonds.
Make it holders, yeah.
Into swapping them,
Yeah.
trading their regular interest-paying bonds for something totally new, bonds that, get this, never mature and pay zero interest.
Perpetual zero-coupon bonds. It sounds, well, almost like science fiction in finance terms.
It does. Sounds wild. But apparently there's some thinking behind it, and that's what we want to unpack today. Right?
Absolutely. And we're drawing on analysis looking at these kinds of potential shifts, like the user's guide to restructuring the global trading system you mentioned. It talks about significant changes being possible.
So our aim here isn't to say this is good or this is bad or even this will happen.
No, not at all. It's about understanding the idea itself. What's the core concept? What's maybe the rationale someone might propose? And importantly, what do the analyses say about, feasibility and the potential fallout?
Okay, let's break down that basic idea. Tariffs, we know they make imports more expensive.
Standard tool, yeah.
But here, the idea is targeting specific countries with tariffs because they hold lots of U.S. debt. So the goal isn't just trade adjustment.
Right. The goal is pressure. Economic pain, essentially.
Okay, what's the specific pressure point? What are they trying to force?
Okay, so the desired end game in this hypothetical scenario is to get those countries holding, regular U.S. treasuries.
The ones with coupon payments and maturity dates.
Exactly, the standard bonds, to exchange them for these perpetual zero-coupon bonds. Let's just pause on what that means.
Yeah, unpack that. Perpetual zero coupon.
Perpetual means they never have to be paid back. The principal amount just stays out there indefinitely. And zero coupon means no interest payments, ever.
So if a country, say Japan or someone, agreed to this, they'd be swapping an asset that pays them interest and promises their money back.
Correct.
For a piece of paper that pays nothing and never gives the principal back.
That's the essence of it. From the U.S. perspective, it looks like, well, a way to make a chunk of the debt just disappear in terms of future obligations.
A pretty significant cancellation of what's owed then.
Yeah.
Both interest and principal.
Exactly. And, this isn't happening in a complete vacuum. That user's guide connects this to broader discussions about burden sharing.
Burden sharing.
Yeah, the idea that the U.S. provides the global reserve currency, the dollar, and this massive security umbrella.
Right, military protection and stability.
And maybe the countries benefiting from that should, contribute more directly. This bond swap is being floated as perhaps one very unconventional way they might contribute.
Framing it as contribution. That's an interesting spin. So what's the underlying reason for even thinking about something so drastic? What problem is this supposedly solving?
Well, the biggest one seems obvious. The U.S. national debt. It's huge.
Can't argue with that.
So instead of, the usual painful options, austerity, big tax hikes, or outright default, which is unthinkable.
Politically toxic, mostly.
Right. This looks like maybe a side door? An indirect way to reduce the debt burden held by foreigners, at least. Though, as we'll see, it's incredibly risky.
A shortcut through a minefield, maybe?
Could be. And there's another layer. The user's guide brings up the Triffin world idea.
Okay, refresh us on that.
Basically, the country issuing the world's reserve currency kind of inherently ends up with an overvalued currency over time.
Because everyone needs and holds your currency.
Exactly. So an argument for this strategy might be, look, these countries holding massive treasury reserves are contributing to the dollar being too strong, which hurts our manufacturing.
So it makes U.S. exports expensive and imports cheap.
Correct. So forcing this bond conversion could be framed, maybe cynically, as a way to correct that perceived trade imbalance, too.
So it's pitched as tackling debt and helping U.S. industry. A two-for-one deal.
That seems to be the potential justification, yeah. And it connects to some other ideas, like from Zoltan Posar, about linking the security umbrella to finance.
How so?
The idea that countries inside the U.S. security zone should help fund it. Traditionally, they do that by buying treasury-safe assets. This proposal just takes that concept and, well, pushes it much, much further.
Into essentially forcing them to hold these zero-interest perpetual things instead.
Right. A much less attractive proposition for them, clearly.
Okay, I think we've got the basic idea and the, let's say, potential logic, however controversial. But now, the big question for everyone listening. Could this actually work? What are the roadblocks? That other document, Trump's tariff-backed bonds, seemed really skeptical.
Extremely skeptical, and for good reason. Let's start with the legal side. This is probably the first massive hurdle. As that analysis points out very clearly, U.S. Treasury bonds aren't just informal IOUs. They are legal contracts.
Binding agreements.
Binding agreements with very specific terms. Coupon rate, maturity date, redemption value, forcing bondholders to swap them for something fundamentally different. It's something they never agreed to.
Like a perpetual zero-coupon bond.
Would almost certainly be seen as a violation of that contract, a unilateral rewrite.
So, breach of contract on a sovereign scale.
Yeah.
What would that look like legally?
The analysis suggests it'd be viewed as a form of disguised default or debt repudiation, essentially the U.S. saying, we're not going to honor our original promise, or at minimum, a kind of partial expropriation taking value away from the bondholder.
Taking away the interest in the promise of getting the principal back.
Exactly, and the document highlights a very high likelihood of legal challenges, not just in U.S. courts, but potentially international ones too.
That sounds incredibly messy. And what about the bedrock principle? The whole full faith and credit of the U.S. government?
That's the core issue, isn't it? It risks shattering that trust. If the U.S. government signals it's willing to just change the terms of its debt contracts unilaterally,
Especially against allies holding the debt.
it fundamentally undermines the perception of U.S. treasuries as safe, reliable assets. It erodes the very foundation of trust that the dollar's global role is built on. For any investor, anywhere, it raises huge questions about future U.S. reliability.
Yeah, you damage that trust. The consequences could be immense. Let's talk about those consequences. Beyond the legal fights, how would financial markets likely react?
Oh, it would likely be swift and brutal. That analysis paints a pretty grim picture.
I bet.
First, you'd almost certainly see confidence in U.S. treasuries just evaporate. They're seen as the world's safest asset right now. This would change that overnight.
So a sell-off.
Potentially a massive sell-off, leading to a downgrading of the U.S. credit rating, maybe severely. We've seen downgrades before over debt ceiling issues, but this could be far worse.
And what does that mean practically for the U.S., for the global economy?
Well, think about it. Massive capital flight is a huge risk. Money pouring out of U.S. securities looking for safer havens.
Okay.
That forces the U.S. government to offer much higher interest rates, higher yields on any new debt it issues just to attract buyers.
Making borrowing way more expensive.
Significantly more expensive, which ironically adds to the very debt problem this was supposedly trying to solve.
Right, it backfires.
And you could see a sharp, sudden drop in the dollar's value. That could trigger serious global financial instability.
The analysis is clear. The long-term costs would almost certainly dwarf any imagined short-term fiscal gain.
Okay, so legally fraught, but potentially disastrous for markets. What about politically, geopolitically? How would U.S. allies react to being strong-armed like this?
Yeah, the Trump's tariff-backed bonds analysis is blunt here.
Yeah.
It suggests allies think Japan, EU countries, South Korea, big treasury holders would see this as, quote, coercive economic imperialism.
Strong words, imperialism. Well, put yourself in their shoes. Your major ally is using trade threats to essentially force you to accept a huge loss on your national savings held in their bonds. It feels hostile.
Not exactly alliance building.
Hardly the most likely outcome. These allies would aggressively try to reduce their reliance on the U.S. dollar. It would pour fuel on the fire of de-dollarization efforts that are already, simmering.
So pushing them away from the dollar.
Pushing them away, potentially destabilizing long-standing alliances, maybe even encouraging them to build stronger economic ties with rivals like China or within the EU as alternatives.
Could they do anything proactively?
They might even start reducing their purchases of U.S. assets now or diversifying away more quickly just as a defensive measure against this kind of potential policy.
Wow. So it could weaken the U.S. position globally quite significantly. But let's step back. Even setting aside the consequences, how effective would the leverage actually be? Would tariffs really be enough to force countries into such a massive financial concession?
That's another key point of skepticism in the analysis. Tariffs hurt? Yes. They can be a tool in trade talks.
Sure.
But are they powerful enough to make a major diversified economy like Japan or Germany completely overhaul its sovereign wealth strategy and accept perpetual zero-interest bonds? The analysis suggests probably not.
Why not?
These are allies with complex economies, strong political systems. They can likely absorb some tariff pain, and they're far more likely to retaliate with their own tariffs, diplomatic pressure, legal challenges, than to just cave on something so fundamental.
So the U.S. might just end up in messy trade wars without actually achieving the bond swap goal.
A very real possibility. It's not like leveraging tariffs against a much smaller, more dependent nation. These are major economic players.
Okay. And what about the blowback here at home in the U.S. if these tariffs were imposed?
Right, the domestic impact. It's often overlooked in these grand strategies. Tariffs mean higher prices for imported goods.
Inflation for consumers.
Right.
Us.
Exactly. And tariffs tend to be regressive. They hit lower-income households harder. Plus, you risk disrupting supply chains for U.S. businesses that rely on imports.
More economic pain points.
Definitely. Could worsen inequality. And there's another subtle risk. If the Federal Reserve, the central bank, is seen as somehow facilitating or endorsing this kind of coercive debt conversion,
If they're pressured into it.
it could seriously damage the Fed's credibility and independence, which is crucial for long-term economic stability.
Man, it just seems like downsides keep piling up. Has anything remotely like this ever been tried before? Is there any historical parallel?
That's a great question, and the analysis emphasizes the lack of precedent. Forcing allies into this kind of unfavorable debt restructuring during peacetime without an actual default situation, it's pretty much unheard of for a major power.
So things like post-World War I reparations.
Different context that was imposed on defeated enemies, or even when the U.S. government altered some debt contracts during the Great Depression.
Right, the Gold Clause cases.
Yeah, that was a severe domestic crisis, internal debt contracts.
Yeah.
This is targeting foreign allies holding external debt under very different circumstances. It's not comparable.
And didn't the U.S. do the opposite after World War II?
Exactly. The Marshall Plan involved forgiving debts and providing aid to strengthen allies. That fostered stability and trust. This proposal is the polar opposite, using coercion, risking instability.
So the conclusion seems to be, this is more about political power plays than sound economics.
That's what the analysis suggests. It leans more towards brinkmanship than monetary logic. Ultimately, debt sustainability for a country like the U.S. relies on credibility and trust, not trying to bully your creditors, especially when they're also your allies.
Okay, last piece then. We touched on de-dollarization. How does this whole discussion fit into that broader trend?
Well, the analysis notes that de-dollarization, central banks diversifying reserves, more bilateral trade in local currencies is already happening, albeit gradually. The dollar still has huge advantages: deep, liquid markets, inertia, lack of perfect alternatives. But a policy like this, threatening allies, undermining trust in treasuries, that could dramatically accelerate the move away from the dollar.
Like pouring gasoline on that slow burn.
Precisely. It gives every country a powerful incentive to find alternatives faster, seriously eroding U.S. financial power over the long term.
So let's try to wrap this up. This idea using tariffs to force countries into accepting perpetual zero-interest bonds. Well, it might sound like a maybe creative solution to the debt problem on the surface.
A quick fix temptation.
The analysis we've looked at suggests the reality is incredibly perilous.
That sums it up well. The legal hurdles look immense, the potential market reaction catastrophic, the geopolitical damage severe, and the risks to the U.S. economy itself are significant. It seems highly improbable to succeed and likely to backfire badly.
It really underscores how vital trust and credibility are in the whole global financial system, doesn't it? And the dollar's role depends heavily on that.
Absolutely. You can't just decide to change the rules on your creditors, especially your allies, without expecting major consequences. It's a system built on confidence.
It really highlights the tightrope walk nations have, balancing their domestic needs, like debt, with their international standing and relationships.
It does. And maybe that leaves us with a final thought for listeners to chew on.
Go for it.
Even if this specific extreme strategy is unlikely, could the fact that it's even being discussed signal something broader? A potential shift towards nations considering more aggressive, unconventional economic leverage in international affairs.
Like the norms are changing.
Possibly. What are the long-term ripples if these kinds of coercive economic ideas start moving from the fringes closer to actual policy consideration? What does that mean for global stability and finance?
That is definitely something to think about. A slightly unsettling note to end on, perhaps.
Well, it reflects the complexities of the current global economic landscape.
Indeed. Thanks again for walking us through this complex and, frankly, Quite startling material. Really appreciate the insights.
Glad to be here. Always interesting stuff to discuss.
And thanks to all of you for joining us on the deep dive. We'll catch you next time.